Hey everyone, hopefully you're having a good day. My name's Andy, my channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and or financial topics. So let's jump right in, take a look, see what's going on today. If you want to follow me, it's at @Finance. And if you want to join our community, finding-value.com, where I go and dive through all these different investment opportunities and share them with everyone in the community. I do that through midweek updates and also Q&A sessions on the weekends. Special coupon code, it is still active. You get 50% off the first month on a monthly membership and a $100 discount on the yearly membership if you'd like to either directly sign up to a yearly or switch from a monthly to a yearly. Going with Dow, gold equals 1. I laid an exact clone of the 1980 to 2002 oil trading structure, which is in yellow on the left-hand side, onto the most recent 22 years pink. It's a pretty good fit, if I do say myself. The yellow pattern produced a 6x move upon breakout of the small consolidation, which would give us a $360 oil price this time around. That is the fractal pattern there that he's looking at. So this is the consolidation in the yellow. Wave 1 is the breakout out of the consolidation. This is wave 2. And then wave 3 is up, wave 4, wave 5, and then we go into another consolidation. This consolidation is the same as this consolidation. What we can do is we can see and overlay this fractal here on top of wave 1, and we're in a wave 2 pullback that we haven't broken out of yet. We could be getting close. Are we going to get a little dip lower before heading higher? It's always possible towards the end of these falling wedges. They can always do a little bit of a false breakdown. Like there's one here, there's one here, and there's actually one here too. So what I have is, this is US oil. I have 3 cycles: consolidation, bull cycle, consolidation, bull cycle, consolidation, and we're going into a bull cycle. We've broken out of the angled trend line. So this here, I think we're in wave 2. This is the fractal from back here that I adjusted over, and that's roughly the adjustment. I get a price that can go way up there. Way up there. Now, this isn't oil going up. This is the dollar going down. And then gold's going to go up. Silver's going to go up. Most everything that is priced in dollars is going to go up. Beef, gasoline, oil, natural gas, uranium, silver, tin, lead, zinc, it doesn't matter, guys. Copper, they're all priced in dollars. And if the dollar falls, these are all going to go up. So we have these fractal patterns, these patterns that repeat over time. That's what a fractal is. And they're all in alignment for a big commodity bull market that is in progress. People don't see it because they focus on the short term, but this is zoomed out on the long term. And other people are starting to see this formation. Russia is slamming America's stablecoin push. Special advisor to Putin, Anton Kobyakov, is that, did I say that right? Kobyakov says it's a scheme to shove 35 trillion of debt into crypto, devalue it, and reset the system. Jacob says couldn't agree more. Now, do I know for sure this is going on? It seems like that's what they're trying to do. I'm here to just share information that I'm seeing on Twitter, so you guys get up to date stuff that people are looking at. But it seems pretty plausible. Benjamin Graham says the essence of investment management is the management of risks, not the management of returns. Well-managed portfolios start with this precept. So it's the management of risks. How do you manage risk? Well, you buy it only when things are cheap, when things are down. That's management of risk. You wait until an asset is undervalued. You wait for the cycle to be towards a cycle bottom, not a cycle top. And that's when you buy. Buy assets when they're cheap. That is handling risk. Chasing price because something has gone up is not handling risk. If you're looking at what is the average 10-year return on an investment, that's not handling risk. You're just chasing price. That's just chasing price. I don't know how to pronounce his first name here. I don't even want to try. I have to admit that this chart is not what I wanted to see. If a run like this happens in yields, it is definitely not going to bode well for the markets. So what is this? This is 10-year yields, and this is gold. This is gold around a 20 months in advance, and you can see the overlay of 10-year yields, which are lagged behind gold. Gold anticipates money printing, or insiders that know money printing is coming buy gold first. Put it that way. U.S. Treasury yields generally follow inflation. So if the 20-month advance, are we kind of at this bottom here? We could head higher with yields. Now, if this is true, that also means that oil is about to break out to the upside. Oil is basically the transmitter of money printing through oil into the consumer price index, into interest rates. So this is a predictor. This is the lag, the ultimate lagger, and this guy's in the middle of it, the oil price. Giovanni says, an interesting interview. Jeff Curry talks about the oil market following the decision by OPEC Plus to boost output again. There's no spare production capacity in the system. Adding that Saudi Arabia is in the driver's seat. He adds, I'm not going to completely discount inventory build as the market absorbs this production increase sometime in the next 12 months. But that doesn't mean prices are going to go down. So he doesn't think that prices will necessarily go down even with the increases. And with the increases of OPEC, that basically puts the power in Saudi Arabia's hands because there's no spare production capacity in the system anymore. This is it. We're coming up to it. This is it. We're in the corner here. This here, a lot of people, what they do is they listen to articles, they listen to opinions, and then they make their own opinion based off of other people's opinions. That's not how I do it, guys. I go off the charts here. The chart is screaming that something is coming. Are we at the tip where it's going to go higher? I don't know that for sure. No one does. Do we get a false breakdown first before going higher? It's completely possible. We may not, though. No one knows that answer. Everybody wants to be told something, and then they want to believe in something. It's like, if you want to be told what to believe, go find a religion or something. Like this here, we don't know the future. Could this be a break to the upside immediately? It could be. We don't know. We'll wait and see, and we'll watch to see what happens. Coming up, the reason why gold and silver can end in a melt-up is that once in a while, nobody is willing to sell no matter what. Insurance policies are very reluctant to be canceled, similar to how the VIX can experience extreme spikes when everybody wants a hedge. I read these things, and everyone's trying to put reasons to why something can do something. What about this? What if it doesn't matter to me? What if the entry point for gold and silver is when we squeezed up, it was really cheap in relationship to other assets, and you just buy it. And then you don't worry about what people think. You don't worry about the reason. Well, why? Why is it doing this? Why? We don't know the short-term reasons, guys. The longer term, yeah, there's a ton of debt. Interest rates are going up, and people need something to go into to protect themselves against inflation and the destruction that interest rates going up is going to occur. If interest rates are going up, the bond market is going down in price. You can't have it any other way if interest rates are going up. And if interest rates go up past, I'm going to say 4.5%, 5%, somewhere in there, what we've seen is that it's become a huge headwind for stocks in the general equity market, like S&P 500 and the NASDAQ. So if you can't go into bonds and you can't go into the S&P 500 and you can't go into NASDAQ because of the interest rates going up over a critical or crucial point, then where do you go? Where do you go? There's no other spot. It's commodities and precious metals. That's it. And they're underpriced at 100-year lows. Guys, this is a no-brainer to me. But people look at the short-term market movements, and then they try to make up narratives based off the short-term market movements. It's all part of the big cycle. And what's about to get unloaded is a bunch of financial assets are going to be unloaded, and they're going to go running for something else when everybody wants a hedge. Here's the, it says we are 5% from a massive breakout in the overall commodity index. If that breaks, all-time highs seem like a certainty. So there's that falling wedge. Do you know what else had that falling wedge? Oil had that falling wedge. You know what else has this falling wedge? A whole bunch of other things. Energy companies have it. A whole bunch of other things do. We've got the breakout here, clear breakout. 2021 breakout. We had a consolidation here. It's now heading higher, and we're coming up through resistance, perhaps, at any second here. We break through that resistance, we could be running higher here. We got a lot of good stuff going on for commodities and precious metals in terms of the charts. They look very good. Very good. And we'll see if that happens. Tim Hack, another one, says precious metals appear to be gearing up for a melt-up. The pace of the upward movement will now increase exponentially. Now, does he know that? Does he really know that it's going to increase exponentially? I don't know. I mean, sure, it looks like it could do that for sure. You know, when I look at these things, I entered silver, I have gold, I entered platinum, physical metals, I've entered mining companies all across the board, oil and gas, energy service. I'm loaded in the commodity and precious metals space because that's where I think the opportunities are at. The opportunities were there when all the charts were bottoming. They were all cheap. Ratios were cheap. Everything was a smoking buy over the past 5 years. From 2020 till today, everything's been a smoking buy for the most part. Everyone's going to start to figure this out. Everyone's going to start to say that the pace of the upward movement will now increase exponentially. This is going to be a big FOMO, fear of missing out. People are going to start running away from some assets, which pain will be inflicted upon them, and they're going to run for the things that are going up. The ones who make the most amount of money are the ones who are first. And the question that everyone should ask is, how can I be first? What do I need to do in order to be first? Being first is lonely. You must think differently than everyone else. You must go against the crowd. You must buy things when things are cheap but unwanted. And then you have to be patient enough to sit and do nothing. While everybody tells you that you're wrong, while other asset classes may be outperforming you in the short term, you sit, you accumulate, you buy, and you do nothing. And then you wait for this to come. They appear to be gearing up for a melt-up. Wow, like we didn't know that was coming. It's really? So I don't care I don't care the path, guys. It doesn't matter to me. I don't care if it goes straight up. I don't care if it takes 5 or 10 years. It doesn't matter. I've positioned how I should have played my hand. I played my hand as best as I could, bought where I should have, and then sat and wait for this to play out. The Great Marti, Japanese yields look set to rocket. Consequences of not raising rates won't be long. Look at that breakout here. Nice little cup and handle. Breakout to the upside for yields going up on the 30-year in Japanese yen. What does that mean? Why does it matter? Well, if bond yields are going up across the board, we may see bond yields go up in the United States too. We might. But Andy, they're going to lower interest rates. Okay, let's watch. Let's watch and see what happens to the long end of the curve. We could see all these start to break upward. Now, Josh has the question, and I think it's a good question. Is gold going up because interest rate cuts are coming or because they shouldn't be cutting? I'm not exactly sure. Are we cutting interest rates because we need to? Or are we cutting interest rates because we have to and they shouldn't be cutting them? I don't know. I really don't. In all honesty, guys, I really don't know the answer to this. I think I wouldn't put it past people to doctor the numbers in whichever direction they want. And with inflation where it's at, and I'll show you a chart or two below here, inflation is breaking out against deflation. So I think I'm going to go with the latter. Why would I go with the latter? Or because they shouldn't be cutting? Because the charts are telling me. What you're doing with charting is you're looking at the internals of the market. And you're observing how people are positioning in the internals of the market. So all across the board, you can see how people are positioning in certain sectors. The sectors that are bottoming and about to go up are all over the place in commodities. Do you know when commodities go up? They don't go up during deflation. They go up during inflation. Inflation would increase interest rates like this yield on the 30-year Japanese. That's inflation. That's not deflation, guys. That is inflation. So if someone comes out and says, well, you need to be worried about deflation, then tell me why interest rates or yields are going up. If we need to worry about deflation and the smartest people in the world are selling bonds, tell me why that's the case. They can't. Their narrative is jacked. Positioning in the market over trumps narratives that people make up. OPEC plus oil supply hike will likely undershoot plan, Gunvor says. Now, here's another thing. What if we print all this money and there's not enough oil in the system and we actually moonshot oil? Man, that's going to be bad. That's going to be a rough inflationary spike. And I think that's coming. This is silver priced in US dollars, Renko chart. A Renko chart of silver adjusted for inflation shows also what I've been saying for the past 1.5 years, that the big momentum change for silver and gold and also the miners was April of 2024. Lovely, clean breakout here. As this is a breakout in the Renko chart for silver priced in dollars. North Star says Bitcoin or gold. This chart tells you the answer with zero bias. We've broken down where it favors gold over Bitcoin. What does that mean? Well, it means that Bitcoin could underperform. It means that, and I think this is a possibility. I don't know for sure. I think Bitcoin could go bust. Like it could actually just default, like break, where the price gets so low that mining companies cannot exist, and I don't know how the network works at that point. So I don't know. We'll see. We'll see what happens. Nice little shoulder maybe too. We'll see. Grady says this kind of quality you can expect at the service, clean, clear, to the point technicals with huge value. I waited patiently for the commodities bear market lows for years. Called it in linked post below back in 2020 for the Canadian TSX Venture. To the very day in real time, this was the start of the TSX Venture bull market. Hope you took notice since it was a generational low. Also posted on the breakout from the purple bullish expanding falling wedge on the big picture chart below, saying the TSX Venture was now ready to resume its bull market and that it would now break out above the 17-year blue bullish falling wedge. And it has now done just that. So TSX Venture, this is a proxy for small mining companies and stuff like that up in Canada. We've broken out of the falling wedge here, guys. What does that mean? It's go time. This is it. It is go time. The measured move price is 330% upwards of this TSX Venture. Now, individual companies can go much, much, much more than that. So here we go. We're starting the move. JP Morgan warns of a Fed rate cut pullback. JP Morgan's trading desk warns the Fed's expected September 17th rate cut could spark a sell the news drop in U.S. stocks. Despite the S&P 500's 30% rebound since April, risks from inflation, weak jobs, tariffs, and seasonal September weakness remain. JP Morgan suggests hedging with VIX calls and adding gold, though history shows rate cuts outside recessions can still lift markets. So why are they cutting interest rates? Is it because a recession's coming? Is it because of unemployment? Or are they lowering interest rates on that last one that says rate cuts outside recessions can still lift markets? I don't know. We'll have to see what transpires here. Looking back 130 years, this is the most overvalued stock market by any metric. This will end in tears, says Lucas. Yeah, we're up there in terms of valuation. Bull market commodities, bull market commodities, bull market commodities. These are all the starts of bull markets and commodities. So hopefully that's the start of the bull market of commodities. 99 was a great entry point for commodities. Absolutely fantastic. Late 60s was a good one, like 69. Yeah, that's really good. So we're coming right into a bull market of commodities here very, very soon. We're in it, but I mean the continuation of a big move is what I should say. Gold opens the floodgates, silver follows. So this is silver tracks gold's rate of change. We've got the gold's 10-year rate of change, and it's broken out and heading higher. It's moonshotting. And silver follows that rate of change of gold. So here we are, and we're going to probably see silver with a massive breakout. Massive. We're going to be racing platinum and silver, I think, at some point here. Silver next. So we've got GLD ripping it and SLV just breaking out here, ready to rip higher and follow what gold's doing. Agreed. Oil exploration capital has been shrinking at an alarming rate since peaking in 2013. Combined exploration capital for 10 oil companies have shrunk 71%, from $37.6 billion in 2013 to a mere $10.8 billion in 2024. So CapEx and exploration capital, it's way down. Way down. Another one from Grady, and I like this chart quite a bit. This inflation versus deflation index chart was in a range for 8 years. Then it broke down for a very probable blue false breakout, which it was. Now we're breaking upwards from the pink bullish falling wedge. Getting prepared for a second inflationary wave is now imperative. So this is an inflation index versus deflation. Monthly 10-year chart. You can see we're heading lower here all the way to the tip of 2025. We have broken out. This is a false breakout. False breakouts create slingshots. Slingshots are big moves to the upside that can happen quite rapid. We're seeing gold react to it, and all the rest follow gold. So this is it. We've got confluence, the merging of information of this inflation index versus deflation index, and gold rip it higher. So more than likely, commodities are going to come and follow next. Watch energy. Energy is going to be a big move, I think. A big, big move. Freight futures AM update, dry bulk, Capesize is up 3%, Panamax up 1%. And tankers, VLCC is down 2%, Suezmax is flat. And that's all I've got for today. So that's where we're going to end it. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Special coupon code there. And that's all I've got for today. So we'll catch you next time, guys. See ya.